In 2008, America's biggest banks were not robbed. They were not attacked. They were not destroyed by war. They collapsed from the inside. No explosions, no foreign enemy, no invasion. Just numbers on screens, balance sheets, contracts, and decisions made quietly over many years. Trillions of dollars vanished. Not slowly, not gently, but in waves. Stock markets raced decades of gains. Pensions shrank. Savings disappeared. Millions of jobs vanished. Factories shut down. Offices closed. Construction stopped. Careers ended overnight. Homes were lost, not because of fire, not because of flood, but because payments suddenly became impossible. Families packed boxes. Keys were left on kitchen counters. Neighborhoods emptied. And the most shocking part was this. The system did not break suddenly. It did not explode. It did not collapse in one moment. It broke slowly, quietly, in plain sight. This is the story of how American banks collapsed in 2008 and how the entire world paid the price. Before 2008, the American banking system looked stronger than ever. Profits were high, quarter after quarter. Stock prices climbed, bonuses grew, confidence spread. Credit was cheap, interest rates stayed low, borrowing felt easy, money felt abundant. Home ownership expanded. More Americans owned houses than at any point in history. New suburbs spread outward. Construction cranes filled the skyline. On the surface, everything appeared stable, safe, controlled, permanent. But beneath that surface, risk was quietly spreading through the system. Not loudly, not recklessly, at least not in appearance. It spread through contracts, through formulas, through financial engineering few people fully understood. Banks had discovered a powerful engine for growth. Housing, mortgages, debt tied to real estate became the foundation of modern finance. For decades, home loans were simple. Banks lent money. Borrowers paid it back. Risk stayed with the lender. If a borrower failed, the bank absorbed the loss. That structure enforced discipline. Banks cared who they lent to. They verified income. They required down payments. That changed. Wall Street found a way to turn mortgages into products. Not homes, not families, but financial instruments. Banks bundled thousands of home loans together, prime loans, subprime loans, fixed rates, adjustable rates. They mixed them into large pools, then sliced those pools into pieces. These pieces became mortgage-backed securities. They were sold to investors across the United States and across the world. Pension funds, insurance companies, hedge funds, foreign banks. Risk no longer stayed in one place. It was distributed everywhere, across institutions, across borders, across balance sheets. This created a dangerous illusion. Because risk was spread, banks believed it was reduced. But spreading risk does not remove risk. It hides it. Rating agencies stepped in. They used models, historical data, assumptions based on decades of rising home prices. Many of these securities were labeled safe, AAA, the highest possible rating. Pension funds bought them. Insurance companies bought them. Foreign central banks bought them. Everyone trusted the math. Everyone trusted the models. Everyone trusted each other. To feed this machine, banks needed more mortgages, a constant supply, an ever-growing pipeline. Standards fell. Loans were given to borrowers with weak credit, sometimes no credit at all. Income checks disappeared. Documentation became optional. So-called no-doc loans spread. Adjustable rates replaced fixed payments. Low teaser rates hid future costs. Payments started small, then reset higher. Housing prices kept rising. Year after year, city after city. Defaults seemed impossible. If someone failed, the house could always be sold. That assumption was wrong. By 2006, housing prices began to slow. Not collapse, not crash, just slow. By 2007, they began to fall. When prices dropped, refinancing stopped. Borrowers could not roll debt forward. They could not escape rising payments. Monthly payments rose. Defaults increased. The weakest borrowers fell first. Then stronger ones followed. Mortgage-backed securities began to lose value, but no one knew how much. No one knew who held what. Complex structures hid exposure. Balance sheets became opaque. Banks stopped trusting each other. Lending between institutions froze. This was not panic yet. It was uncertainty. But uncertainty is deadly in finance. Investment banks relied on short-term borrowing to survive. They borrowed overnight. They rolled debt daily. They depended on confidence. When lenders pulled back, liquidity vanished. In March 2008, Bear Stearns collapsed, an iconic Wall Street firm, decades old. It was sold in an emergency rescue, a fire sale, a warning. The warning was ignored. In September 2008, Lehman Brothers failed, one of the largest investment banks in American history. The government let it collapse. Markets panicked. Stock prices crashed. Credit markets seized. Money funds broke the dollar. Banks hoarded cash. Businesses could not borrow. Payrolls were at risk. The financial system stood hours away from total collapse. Fear spread faster than facts. Major institutions followed. Merrill Lynch was absorbed. AIG collapsed under insurance guarantees tied to toxic securities. Citigroup teetered. Bank of America teetered. The problem was not one bad bank, it was the system. Leverage amplified losses. Small declines became catastrophic. Complex derivatives hid exposure. Even executives did not understand their own risk. Risk models failed under stress. They assumed normal markets. This was not normal. Regulation lagged behind innovation. Rules built for old banking did not control new finance. Incentives rewarded short-term profit, not stability, not responsibility. When housing fell, everything connected to it fell too. The government stepped in. Trillions of dollars were committed, not to reward banks, but to prevent collapse. The Federal Reserve injected liquidity. It opened emergency lending facilities. It expanded its balance sheet. The Treasury launched bailouts. Capital was injected. Guarantees were issued. The system survived. But the damage was severe. Millions of Americans lost jobs. Millions lost homes. Retirement savings were wiped out. Banks survived. People paid. The 2008 crisis reshaped America's view of finance. Trust collapsed. Anger followed. New regulations were written. Capital requirements increased. Stress tests became standard. But the deeper lesson remained. Financial systems do not fail overnight. They fail when incentives reward risk without responsibility. They fail when complexity hides truth. They fail when belief replaces caution. The 2008 collapse was not caused by one decision, not one institution. It was built slowly, loan by loan, security by security, quarter by quarter. This is why the crisis still matters, because this structure survived, because memory fades, because debt always returns. The story of 2008 is not only about banks collapsing, it's about what happens when finance forgets its purpose. If you want to understand money, power, and history the way it really works, this channel is for you. At The Financial Story, we break down the moments that shaped the world. One crisis, one decision, one system at a time. Subscribe to The Financial Story and learn how money moves history.